Well, as America's debt deadline approaches, words have been enough to calm financial markets. Markets rejoiced amid signs that Washington is moving closer to a deal to lift its massive debt ceiling. But a major bank claims the celebrations are misguided because the political impasse has already made its damaging mark. Here's finance correspondent Philip Lasker.
Looking at financial markets, you wouldn't know we're just days away from a crisis that's potentially bigger than the GFC.
Any right-thinking policymaker wouldn't allow it to happen. So they're very much assuming that a deal will get done.
There's been some progress on the Senate side with Republicans recognizing it's not tenable.
But the dire warnings keep coming, this time from Treasurer Joe Hockey while in New York.
If the United States suffers a heart attack, there's without doubt it'll affect the rest of the global economy.
The entire global monetary system is based on US bonds, seen as easily tradable and risk-free. A default would break that article of faith that keeps markets functioning. Money markets, which rely on the bonds as a kind of currency, would start seizing up as people worried about their value. The banking system would be paralysed because US treasuries are used as collateral for some lending between banks. And there'd be forced selling by global investors of assets like shares where bonds are used as collateral.
The financial markets have been too complacent and they haven't actually emphasised to Congress how worried they are.
Financial market complacency isn't the only issue. A deal will still mean less help for the US economy.
Because whatever deal we broker comes with substantial fiscal concessions. Well, you are obliged to remain credible, to revise down your growth forecasts, and because the US economy is still the centre of the world economy, that has implications for everybody.
Foreigners hold a third of the US government's $16.7 trillion debt, with Japan and China holding the lion's share. They'll start looking elsewhere as ongoing tensions chip away at America's low-risk status, particularly if the resolution is short-lived.
I'm not sure if I was there in China looking after a portfolio of financial assets on behalf of the official sector, that, that would make me look favourably upon US Treasury bonds.
And Australia has contingency plans.
Well, certainly we have back pocket plans to deal with whatever arises over the next few weeks as a result of negotiations.
Lower interest rates will undoubtedly be one weapon, and even if America's political malaise doesn't trigger immediate cuts in Australian interest rates, its underperformance eventually will.
And that's one of the reasons why we think interest rates will be coming down in Australia in early 2014.
That's not the signal coming from the Reserve Bank right now.